Good evening and welcome to another day in advanced taxing or advanced tax. My name is Chima and we are discussing taxation of business income. So, business income, we've been talking about business income since the last class, and we mentioned that we have three situations in which we will not have our normal basis period. So we mentioned that these three periods or these three situations are commencement of business, cessation of business, and change of accounting dates. So the last time we talked about commencement of business, we are going to look at cessation of business. So we ask again, what could make a business to cease? A business could cease because it is not making profits. It is making numerous losses and it is affecting the going concern of the business. So the business could come to an end. It could also be a partnership business that has come to an end. You know, some of these businesses that are partnership that comes to an end could be death of a partner, insanity of a partner, bankruptcy. Even a sole proprietor business could come to an end. Maybe the owner dies, bankruptcy, and so on. It could be through merger and acquisition, and a business comes to an end. So, whatever reason that is given, when a company permanently ceases to carry on trade or business, then we can say the company has ceased business. Section 29, subsection 4 of CETA says that when a company permanently, so we underline that word permanently, meaning that a business could temporarily cease to carry on trade. This is not it. We're not talking about a situation where there is a temporary closure of business. No. Where the going concern has been affected, a company permanently ceases to carry on a trade or business. Or if it is in a case of a company other than a Nigerian company, when it permanently ceases to carry on a trade or business in Nigeria. So we are talking about carrying on businesses in Nigeria. You could hear of people who are selling their investments and leaving Nigeria. We hear of the pharmaceutical company GSK. We've heard of oil companies as Total Energy leaving Nigeria. These are foreign companies leaving Nigeria. They have ceased trading. Could we say it's a permanent seizure? I think so. Now, if a Nigerian company stops trading permanently, or a foreign company stops trading in Nigeria permanently, now in an accounting period, because it will always happen in an accounting period, its assessable profit therefrom shall be the amount of profit from the beginning of the accounting period to the date of cessation. So we shall start counting from the beginning of the accounting year to the date of cessation. And not only that, the tax that arises from it shall be payable within 6 months from the date of cessation. What does this mean? It means that if a company who is running from January 1 to December every year, then suddenly it ceases business in, let's say, March. It ceases business in March. We will have to count from January to March. That is the period that we shall be assessing the profit. So that will be the basis period that we shall be assessing the profit. Now, what about the tax? The tax will be payable within 6 months. So it means that from March, we'll start counting, 6 months will end up in September. It means by September, he should be paying the tax. Okay? Now that's for company income tax. This is for company. So we underline here that this applies to companies. This is for company. Now let's go to personal income tax, where it is applied to individual. It's applied to individual. Now we say here that when an individual permanently ceases to carry on trade or business or profession, the accounting profession, the accounting business, or vocation in Nigeria. So the in Nigeria will be there because it has to be resident in Nigeria. Such individuals' assessable income shall be the amount of income from the beginning of the accounting period, to the date of cessation, and the tax thereof shall be payable within 3 months from the date of cessation. So it means that if the example we cited earlier, if it happens to be an individual enterprise that ceases in March, and its accounting period is normally from January to December, we will start assessing its income from January to March, and his tax will be payable within 3 months. So that would be June. So, based on this assessment above, now look at our takeaways. A company that permanently ceases business operation must file must file tax returns for the year of cessation within 6 months. Now, normally, we know that taxes are normally filed. The due date for taxes are filed within 6 months after the end of the accounting period, right? Yes, 6 months after the end of the accounting period. Now, it is taken that the date of your cessation replaces the end of your accounting year, because by virtue of that cessation, you cannot be allowed to carry trade onto that end of the accounting period. No, your business has ended. It's as though your accounting year end has reached. So you start counting from 6 months. From that date, you count 6 months. That is where you must file tax returns. All right? The due date of filing may fall in the year of cessation or in the year following the year of cessation. Either of these two will happen. Depending on the date the company ceased operation in the year. So let's look at an example. If a company stopped operating business between January and June, like in the case we used an example before, the business was stopped in March, and the 6 months to pay the tax elapsed in September of the same year. Assuming it was in June that the business ceased, the 6 months will elapse in December. So we are saying that if the business ends between January and June, anytime between these two months, anytime, the tax return shall fall due in that same year of cessation. That's it. Now, but if it happens to be between July and December, then the filing of the tax, so if it's between July and December, the filing of the tax will be fall due in the succeeding year. So that's just it. This is the takeaways. 6 months. So 6 months after the cessation date, you have to file tax. If your cessation date happens to be in the first half of the year, January to June, then you have to pay your tax. You have to file and pay your tax in the same year. But if it happens to be in the second quarter of the second half of the year, then your due date will fall the following year. So imagine it was July. Let's say you cease business on July 15. 6 months after that will be January of the following year. So that's why we said between July and December, you have to file. The due date must be the following year. Now, that doesn't mean that you cannot pay your tax in the same year. No, but it is the due date that counts in the tax law. You can pay your tax even on the last day of the month of the due date. So it is the last day of the due date that help us to know the tax year. Now let's look at an individual. If an individual carries on business but it ends, the due date of filing cessation is not later than 3 months from the date of cessation. Now, the interesting thing is, if the individual ceases business between January and September, then the filing will fall in the year of cessation. So that same year the business ceased, that is when the due date for filing will be. But if the business ceases between October and December, that is the last 3 months of the year, then the filing of the tax and the payment of that final tax may fall due in the succeeding year. So that's it. So we have seen that individuals, the first 9 months, if the business ceases between the first 9 months, because they have 3 more months left to pay the tax which falls in the same year. But if that business ceases between the 10th month of the year, or yeah, between the 10th month of the year, that's the fiscal year, and the 12th month, which is between October and December, they will pay in the following year. Now, the tax year happens to run from January to December. That is why we are analyzing this. Now, a company may have its accounting period that is different from the taxation fiscal year, but the tax year is looking at it from the fiscal point of view from the tax authority. They usually run from January to December, irrespective of how the company or individual accounting year runs. Now, there is the possibility of filing tax returns of 2 years of assessment in the year of cessation. Now, there is a possibility that in one tax year, you can file 2 years of cessation. Where this occurs, the company or individual must file the outstanding return, must file the outstanding tax return in addition to those arising upon cessation of business. We are going to see all that in an example. So we will see an example where the, the 2 years of assessment will be filed in that year of cessation. We will see that. Look at example 10. This is scenario 1. XYZ Limited as a company makes up accounts to 31st December, and now it ceased operation on April 30th, 2020. Now you see, this falls between January and June. And now this is the new Finance Act. This is the new Finance Act. Now, you know the Finance Act came into effect in 2020. All right, the relevant years of assessment and the due date of the tax are as follows. Now, this is the way I usually ask people to do this. One, the first thing to do is get your date of cessation. Now, in this case, your date of cessation is 30th April 2020. That's the first thing to do. The next thing to do is due date. Due date to file. Open a bracket, 6 months after. Now, 6 months after, so let's count from April. We have 6 months. 4 plus 6 is 10. So the 10th month is October. So I will say October 31st, 2020. Now, this is it. Now, because you are to file on October 31st, 2020, this date now becomes the year of assessment. So your year of assessment is 2020. And that's it. Why is it 2020? Is because the due date to file cessation tax is in 2020. And that makes your year of assessment to be 2020. So now what do? You will normally look at year of assessment is 2020, which is this. Now, since your company makes up its account to 31st December, that will mean that 31st December 2019 is the preceding year basis. So this is preceding year basis. Is the preceding year basis. You have to first of all calculate that one that is outstanding on preceding year basis that ends on your account due date, 31st December 2019. So it must have started in January 1, 2019. Now, this is payable. Due date payable is 6 months after. So it's payable on June 30th, 2020, which is the same 2020 year of assessment. Then the second one that is being filed is one day after this, which starts in January 1, 2020, and is ending on the date of cessation. Now, it looks as though this is actual year basis. This looks like actual year basis. Why? Because the period started from January. That doesn't mean that the cessation filing is always actual year basis. No, this is just a coincidence that it's actual year basis. Now, this is payable 6 months after, which is October 31st, 2020. So this one is the outstanding, and it's in PYB, while this is cessation. Now, this is what we are going to be doing. We are going to be looking at the cessation, and the outstanding. The outstanding will be paid first. The cessation will be paid later. Now, in the above scenario, the company would file tax returns twice, in the same year. One based on the normal preceding year basis, and the other being cessation returns. So that's it. Let's look at an example from an individual. Now, this is XYZ Enterprise. This is an individual, a business name. Now, it makes up its account the same thing, December 31st, and it ceases business operations in April 2021. So you see here, this takes effect for individuals in the year 2021, whereas for companies, it takes effect from 2020. Now, the position will be, now we are looking at what is the date of cessation. The date of cessation is, we said before, find the date of cessation, which is 30th April 2021. Then look for due dates to file, which is 6 months. No, it's not going to be 6 months now. It's going to be 3 months for individual. It's going to be 3 months. So we look for 3 months. So 4 plus 3 is 7, which is going to be 31st July 2021. Now, so what happens? 2021 becomes the year of assessment. So the due date to file becomes the year of assessment. So year of assessment is 2021, and we'll have to do on preceding year basis, because it files tax on 31st December every year. 31st December is the it makes up its account 31st December every year. So the basis period ends in 31st December 2020, which is preceding year basis, and it starts from January 1. Now, he's supposed to pay on or before March, 3 months later. And that's how it is. All business names, they pay their taxes on or before the third day of the third month of the following year. Now, the next day after the outstanding, so we call this one outstanding returns. So the next day after is January 1, and it's going to end on the date that the business ceased. Now, because 3 months later is the due date, which ends in 2021, we see that 2021 again is still the year of assessment. So you need to divide it into these two assessment, because you're not going to join them together. The first one is 2021 year of assessment. It's a different filing. Second one is 2021. This is cessation filing. It It has to be done separately. From the above, the company or enterprise would file tax returns twice in the same year, one based on the normal preceding year basis and the other being cessation returns. Now, this only happens when the business ceases for a company within the first 6 months, or for businesses within the first 9 months. Okay, now let's look at illustration 11. Now you see a situation where the, the company ceases business in the second half of the year. Scenario 1, the company XYZ Limited, that is a company, makes up its account to 31st December as before, but now it is ceasing operation on 31st July 2020. Now, this is the second half of the year. Like we did before, we will need to look at our date of cessation, which is 31st July 2020. Then we'll say due date to file. Due date to file will be 6 months. So the seventh month, if you add 6, it's going to give you January 31st. So this is going to give you 31st January the next year, 2021. Now, 2021 becomes the year of assessment. So the year of assessment is 2021. So what do? 2021, you cannot be saying, okay, that 2021, what happens in 2021? Your businesses started making its accounts to December 30th. So normally, this would have been December 30th. This is January 1, 2020 of the previous year, but unfortunately, you cannot get to 2020 December. You ended it in July, and you are going to file it in January. So what we are saying here is, if the business ceased for a company in the second half of the year, then there will be only one filing in the year of cessation. And the year of cessation in this instance is 2021. The year of assessment of cessation is 2021. No, the year of cessation is 2020, but the year of filing and the due date is 2021. So what we are saying in here is that the year the business ceased is 2020, but cessation returns are paid in 2021. So if you can see here, that's what it says. The cessation returns fall. So this is cessation returns. It falls on this date, falls into the year following the year of cessation. The year of cessation is 2020, but the returns comes the year after. Only one returns comes there. Now let's look at a sole trader. A sole trader that is a business person, makes up his account. This is a a business name, or an individual makes up his account to 31st December. Now he ceased operation on 31st October 2021. Now let's see what happens. We'll first of all look at what is the date of cessation. Date of cessation is 31st of October 2021. Now the due date to file is 6 months later, which is, sorry, 3 months later. So October, we have November, December, January. So it has to be 31st January 2022. So 2022 becomes the year of our assessment. So if you look at it now, 2022 is the year of assessment, and you would have ended in December of that previous year, but no, it doesn't happen that way. It ended in the date of cessation and started in January 1. And you are filing your tax on the following day, the following year, which is January 2022. So if you can see the comment, that's it. This is the relevant assessment period. Let's look at another illustration. XYZ Limited makes up its account to March 30th. So now we are going away from that December 31st. Not everybody do that. Now, March 31st is when it makes up its account. But when did it cease operation? On June 30th. Now, how do we address this? What we do here is we look at date of cessation. The date of cessation is 30th June 2020. Due date, due date will be 31st December 2020. Okay, so 31st December 2020 is the due date, right? But look at what happens. So it is not December ending that we are looking at. Now, 2020, from what I said before, 2020 should have been the due date here, right? But look at what happened. You know you're going to do it on preceding year basis, right? So if you go now, this is your due date, and your account will have to end on 30th June 2020. Now, look at what you are going to do. Leave one line before up, come down, write your due date, 30th June 2020, not the date of cessation, 30th June 2020. That is when the business would have its business ceased. Now, this accounting year, 30th June 2020, when did it start? Normally, you make up your account on 31st March. That means the next day, April 1, 2020, was when this account ended, was when it started rather. Then the previous period would have started or ended in March 30, 2020. Now, that is when it ended. When did it start? April 1st, 2019. Now, in this situation, because you are using preceding year basis, your year of assessment will be 2021. So, in this case here now, we are not going to say that because your tax year is 2020, that we will not say year of assessment is 2020, that the year of assessment is 2021. So we are now going to amend our principle in such that we will need to write the basis period first. After writing the basis period, we will look at the due date also. Then we'll look at the year of assessment, so that it has to be on preceding year basis. That is for this situation. Ordinarily, this is supposed to be 2020 year of assessment. From this situation is supposed to be 2020 year of assessment, but let's leave it the way it is like this. Look at another illustration here. XYZ Limited makes up its account to 30th June and ceased permanently on November 2020. So what happened? Like we usually do, we will say date of cessation is 30th of November 2020. Due date, which is 6 months later, it will be December, January, February, March, April, May. So it's going to be May 31st, 2021. Based on this now, our year of assessment is supposed to be 2021, like we usually say. Now we have our year of assessment 2021. The first one, because you do your business and you make up your account to June, your first one will be from July 2019 to June 2020. And the due date is going to be supposed to be December 2020. So this is supposed to be December 2020. But now, because we are doing preceding year basis, the due date is not going to be 2020 or 2021. Then the next one here, 1st of July to December to November 2020, you have to pay 6 months later, which is in 2021. So now the essence of all of this here is that your cessation filing must be paid 6 months later. That's the same thing we have here, 6 months later. That's the same thing we have here, 6 months later. All right. So from this example, the cessation falls in the following year. Cessation return falls in the year following the year of cessation. Now let's look at illustration 14. XYZ is a sole trader and it makes up its account to June 30th. Now it ceased operation on November 2020. Now what will happen? What will happen? Date of cessation. Date of cessation is 30th of November 2020. Due date, which is 3 months, November, December, January, February. It's going to be February 28th, 2021. That's fine. So, because of this February 2021, the year of assessment is going to be 2021. So what happens? Because this is falling in the third, outside the first 9 months, there's going to be two filings. So you are going to prepare two returns in 2021. One of them will be falling on the due date for the account ending for the company June 30th, which started from July 2019. Then the other one will be from July 1 to the November when the date of cessation is. And now you see here, this is done 6 months after. Of course, this is not done 6 months, but because it is preceding year basis, it will be done in December 2021. So from the above, the cessation returns falls in the year following the year of cessation. So that's it. So we have seen the cessation returns, we've seen different scenarios, and we've come to realize that there is something we have to realize here, that the cessation filing is 6 months after the date of cessation for the company, or 3 months after the cessation of an enterprise. If it is if the date of cessation falls within the first 6 months for the company, then there will be two filings for that year. One will be based on PYB, and the other will be based on the cessation returns. And we saw largely that the cessation returns gives us the year of assessment that we usually use in the filing. All right. So now that we've done this, we will now go and seek a question that require us to do cessation. I will get back to my question, and let's see. Okay, so let's look at this question. This question is telling us about the old method, and it's also, we are going to convert it also for the new method. Now, unlike the previous class, when I started with the old method, in this class, I'm going to start with the new method. Then we are going to go and see how it was formerly done in the old method. Now, Grace Limited has been in business for many years. As a result of the global economic meltdown, the business declined, and Grace Limited, now this is a company, Grace Limited ceased trading permanently on September 30th, 2009. Now, I want us to change this to 2029. I want us to change it to 2029. So that means this should be changed to 2026, 2027, 2028, 2029. And this is also 2029. Now we are told to compute the assessable profit for the last 3 years of assessment. Now we are told to compute assessable profit now for last 3 years of assessment. All right. So now let's do this. Let's go to what we are given. So this is cessation of business. So I will say cessation. Is that the spelling? don't think that's it. Oh, that's the spelling. Cessation of business. Okay, so we are doing Grace Limited. Okay, now what were we given? Looking at our question, the business, we are given that the business makes up its account to 30th June every year. So I would say given account year end June 30, date of cessation September, is it September 30th? Let's look the actual date, September 30th, 2029. September 30th, 2029. Now, this is what we are given. Now, what can we infer? This is what we are given. Inference. Inference. So we infer that due date, due date to file is 6 months after cessation, which ends in when? So we have September, October, November, December, January, February, March, which is March 31, 2030. So March 31, 2030 is when we are going to file. Year of assessment will be 2030. Now, if year of assessment for the last cessation, that we call it cessation, cessation. So that means if we are told to find the last 3 years, the last 3 years of assessment will be 2028, 2029, and 2030. Now, this is what we are told to find. So, this is like your preliminary workings. We will not go now and do something like this. You will come again. Grace Limited. Accessible profit for last 3 years of assessment. Okay, so what do you do? This will be your year of assessment. Basis period, due date to file, and pay, and this will be your accessible profits. Okay, so that's how we are going to arrange it. All right, so we start with 2028. So because the company is making up its profit or making up its account to June 30 every year, it means that it makes up its account to June 30, 2027. So I'll start with that. June 30, 2027. So it corresponds to the preceding year basis. So if I'm standing in June 30th, I want to get the beginning of the accounting year. I'll ask myself, what is tomorrow's date? It's going to be July 1. So July 1 will be here. July 1, 2026. Okay. So when you do that, you are supposed to pay this in 6 months later, which is supposed to be December 2020. Supposed to be December 2028. So write December. What we normally do, we'll count 6 months from this date, but the year will correspond to the year of assessment. So you say December 31, 2028. Now we'll go to the question and look at accessible profit that ends in 30th June 2027. 30th June 2027 is this one here, 426,000. So we'll go back 426,000. This, so I'll put my Naira sign up here, 426,000. Now that's it for that first year. We'll come now to 2029. 2029, it has to be July 1, 2027 to 30th June 28. Now take note here, the company ceased when? Date of cessation is September 2029. Okay, so we are in September 2028. So we're June 2028, so we have not hit that. So you come here, this is going to be December 31, 2029, and you check what was given here. The June 30th, 2028 gives you 398,000. So we have our 398,000. Okay, then we'll come to 2030. Now 2030 we said was the year of cessation, the year of cessation filing. That is the year of assessment. The business ceased in 2029 September. So what happened? The first one will be on preceding year basis, which will be on July 1, 2028 to June 30, 2029. So June 30, 2029, this will be paid in December 31, 2030. That gives me 265,000. So we have 265,000. Now this other one starts from July 1, 2029. And when did it end? It ended in September 30th. September 30th, 30th September 29. 6 months after will be when? 6 months after will be March 31, 2030. So this is 2030 year of assessment. So we have it as 19,000. So this is 19,000. Now the business ended. The business ended in 20 in the ninth month, and we are paying it the previous year, the next year following the year the business ended. So this is how we are going to do this one now. So just take note of how systematic this was done. We started by checking the date in which the business ceased. We counted 6 months after, and it landed us in 2030. Landed us in 2030, and based on that, we choose our year of assessment. So based on that, we choose our year of assessment. All right. So this one here is cessation. So that's what we call cessation filing. Now, according to the old method, so let's look at the old method now briefly. Old tax method. Now, according to the old method, there is something called ultimate year. Ultimate year. Now, ultimate year is the year in which the business ceased. So in this case, 2009 is the ultimate year, 2009. Then, before the ultimate year, we have the penultimate. These are the names that are being called. Penultimate year. Penultimate year is the year before the ultimate year. So, Penultimate year is the year before the ultimate year. Ultimate year is the year the business ceased. So normally we know the ultimate year first. We go 1 year backward, that is the penultimate year. And because they asked us for the 3 years, they are going to be choosing 20, 2007, 2008, and 2009. 2009 being the ultimate year. Now, normally, this 2007 will be done on PYB, no problem. Now, for this penultimate year, we are going to do PYB. We are going to do PYB. Let me write it well here. For the year two, the penultimate year will be PYB and AYB. So you check the two of them and compare which one of them is bigger. That's what you choose. Then for the ultimate year is AYB. So that's how the old rule is. The year before the penultimate year is normal PYB. But when it comes to the penultimate year, you will do PYB and AYB. Then you will compare which one of them gives you the higher. That is what you will choose. Now, I want you to remember when we were doing commencement and we said the taxpayer's right of election. Now, that taxpayer's right of election, the taxpayer had the choice of choosing the lower one, right? That is taxpayer's right. Of business, this is tax administration's right in the penultimate year. So they will now choose which is higher. And they will not choose the AYB for the last year. Now let's look at this question now. So we established that we are doing 2017, 2007, 28, and 29. So here we go. So we will say year of assessment, basis period. Now we will not put date of filing here because that is not important in the old method. Assessable profits. All right. So now we go. We look at basis period. Say it's going to be 2007. So because June 30th is our account year end and it must be on preceding year basis, so year must be 2006. And so it must have started in July 1, 2005. So we'll go to our account and check which one ends in June 2006. 2006, yes, is this first one. Let me use a different color now. Is this first one? 564 500. 564 500. So we'll write it here with my Naira sign. 564 500. And that's for first one. Then we have our 2008. Now, this is our penultimate year, and we are going to treat it in two ways. We're going to treat it on PYB. So PYB will start from where this one stops, July 1, 2006, and it will end in June 30, 2007. What do we have there? Which one is ending in June 2007? Is this one, 426,000. 426,000. So I'll come here and I'll write my 426,000. I'll just roll it one line. I've not chosen. Then I'll still come here again, 2008. So I'll say this is PYB. This is actual year basis. So I'll start with January 1, 2008, and I will end in December 31st, 2008. So I'll go to this account and see where can I find January 2008. I'm going to find it here. So this ends in June and it's a 12 months period. So that means if January 2008 is here, I will need 6 months from here. Then that means December 2008 will also be here. I will also need 6 months from here because it starts from July. So I'll take 6 months here, 6 months here. So I will come and I'll say 6/12 times 398,000 plus 6/12 times 265,000. 265,000. And let's activate our calculator. So we have divided by 12 times 398,000. Now that gives us 199. 199. Let's hold that. And the second one here is 6 divided by 12 times 265,000. That gives me 132,500. Now I'm going to add our 199,000 to it. And that gives us 331,500. 331,500. I'll now write it under here. 331,500. So this is AYB. Now the taxpayer is going to choose this because it's higher. So it means that I would like to promote this one here, down here, 564,500. Then I'll bring this one here, 426,000. This is what gets chosen. Then you come to the last one here, 2009. That's to be actual year. And when did the business end? The business ends when September 30th. It ends in September 30th, 2009. So it has to be January 1, 2009 to 30th September 2009. So we'll check where can we find January 1, 2009. We're also going to find it here. We're going to take 6 months out of it. Then we'll bring this remaining 3 months, July to September. So we are going to take this 6 months, 265. So we will say 6/12 times 265,000 plus 19,000. Yes, 19,000. So what do we do now? The other one gives us, let's do it again, 6/12 times 265,000, and it gives us 132,500. Now let's add our 19,000 to it. That gives us 151,500. So this gives us 151,500. So this becomes your your ultimate year tax. So the question was saying we should justify the option open to the FIROS. The option open to them is that for the penultimate year, they have the choice of choosing between the preceding year basis, which gives us 426,000, and the actual year basis, which gives us 331,500, whichever is higher. So they have that option, and so they choose the higher one. So, do we have any question now before we move to the next one? All right, so I want to believe that we do not have any question at this time, and so we will look at the the change of accounting dates. The change of accounting dates is the next one that we are going to take. Now, this change of accounting date is not covered in the new Finance Act. Now, there are reasons why it was not covered. For one, the change of accounting date, though it usually have overlap and gap, but the main reason is they are all done on preceding year basis. The reason why commencement and cessation of business were specially covered is because of the abolishment of actual year basis. And so they have to redefine how to treat commencement of business so that we do not treat it on actual year basis at any time. And the cessation of business, you see from the old law, actual year basis was being used. They have to, amend it such that we do not use actual year basis. So that's the main reason why these two were covered. Now, nothing is said about gap or overlap as the main reason. No. So in the change of accounting year, you have another abnormal period, which is you'll get gaps and you'll get um, overlap. Now let's look at the principle. The principle did not change. It's still the same way it is treated in the old tax law. That is how it is going to be treated here. So we say change of accounting date. Change of accounting date. Okay. Normally, when you want to file your tax or you are filling your tax returns, the tax authority will ask you some questions. When was your company incorporated? What is your commencement date? What is your account year end date? Now, these are the three dates that are important: incorporation date, commencement date, most important, and account year end date. Now, they expect you that when you have filed your first returns and it is based on your account year end, they will tell you to keep filing on that due date. Keep filing with that end of accounting year in view. But sometimes there come a time where you may need to change your accounting date. Let's say, for example, before now, banks used to have different accounting year until the CBN now gave a regulation that all banks must have accounting year ending in December of every year. And so those who were not using December 31st have to change their accounting date. Another one could be for you, a company acquired another company. Let's say the company that was acquired was using March 31st. The one that acquired it is using June 30. And so because the one acquired must be reporting to the one that is acquiring, the one being acquired will have to change his accounting date. And it is possible that even the acquiree and the acquirer may change their dates for convenience purpose. So this one was using June 30, the other one was June 30, yes, the other one was using March 31st. They may all decide to use December 31st. And so there will be a change for convenience, for administrative purposes, by regulation. Name them. There are reasons for changing your accounting date. Now, when you change your accounting date, you will first of all need to inform the FRS of your intention to change your accounting date. Now, when you tell them of your intention, you tell them when you want to implement the change. This is what the tax authority will do. One, they will find the first year, they will find the first year when you did not file on the due date or on your accounting year end. The first year of change, of change of accounting dates. Now that is your first relevant year. That is your first relevant year. And this is very important because once you get this first year of change right, everything is easy. Then, after getting the first year of change, the next year is your second relevant day. Then the third relevant year. So this is the year following. This is the year following. All right. So once you get to the first year of change, you have unlocked the first piece of getting this right. Now, these 3 years, what do you need to do with these 3 years? Now, the tax authority will do something like this based on the old dates. They will not look at the first year, which is the first relevant year. This is the second year. This is the third year. They will also do that. They will do your assessable profit. They will also do your assessable profit. They will also do your assessable profit. They will now sum them. They will now sum them. They will not come here and say based on the new date. They will still bring that first year and second year and third year. You will get your assessable profit, assessable profit, assessable profit. They will now sum them. Now they will not compare whichever one gives you the higher one, just like we did in penultimate year, same principle here. Whichever gives you the higher, that is what the tax authority will choose for the 3 relevant years. So take note, they will base it on the old dates as if you never asked for change. They will assume that, or they will ignore the date as if you never wrote to them or never asked for change. They will base it on the old date. After doing that for 3 years, they will now come and say, okay, let's do it based on the new date. As if now they are recognizing your new date. They will now base it on those 3 years. They will now choose which one of them is going to be the what they are going to do, what they are going to choose. Now we'll look at a question, but in practice, what the tax authority do is this. Because you've written that they should allow you change your accounting date, you will bring your assessment based on your new date. No problem. They will accept it. Now they will on their own do the old date, or they want you to also do the old date and do the new date on the first year that you are bringing it for them. When you bring the second year, you will do it on the old date, you do it on the new date. Of course, you are paying on the new date for the first year. The second year, you pay on the new date. On the third year, you will still do the old year, you will still do the new year. Of course, you are paying on the new day, on the new year. But what the tax authority will now do is they will now do these 3 years for the old year and do it for the new year. When they see that the old year is higher than the new year, they will ask you to pay the difference between what you've paid and what the old year is saying. So that means they will raise additional assessment that please, oh, this is what we are choosing, this is what you've done, this is the difference, pay the difference. Now, if the new date happens to be the higher, then they will not raise additional assessment because you have already paid the higher of the two. So they will be allowing you to pay on the new date and be filing on the new date while they are taking note of the old dates. And if the old date becomes higher than the new date, they will write you for additional assessment. All right. Now that's the principle. We now go and look at a question. Now this is a company. This applies also for um, individuals in enterprise. Now, the Yadi Trading Company Limited decided to change its accounting date from March 31 to when? December 31. Now, what happened? This has been identified as the old dates, and this is the new date. So, March 31st is the old, December 31st is the new. Now, the reason for the change is for administrative convenience. Its 2007 assessment was based on its account for the year April 1, 2005 to March 31st, 2006. Now, they said this 2007 assessment was based on this. So it means that it was based on the old dates. They filed 2007 based on the old dates, right? That's fine. Preceding year. Now, accounts prepared and submitted during the relevant period were as follows. Now, this was April 1, 2005 to March 31st, 2006. So this year is a 12 months assessment, and it's also this. So this year happens to be what? 2007 year of assessment. Now what happens? This, the second period, they now brought an assessment from April 1 to June 31st, 2006. So they brought another one from April 1 to June 31st, 2006. So because this is 2006, this also becomes 2007 year of assessment. Now we said our normal basis period must have only one account or period ending on the preceding year base, ending on the preceding year. That gives you a normal basis period. But now there are 2 years, two assessment years, ending on the same year and having the same tax year. And so 2007 becomes your first relevant year. Your first relevant year is 2007. Now you are asked to compute the assessable profit for the company for the relevant years of assessment. And now the relevant years of assessment will now be 2007, 2008, 2009. So these are the 3 years that the company will be looking at. Now, if you see, they have started bringing in the new year, they have started filing in the new dates. But because the tax administration they know that they have to compute both old and new. In practice, they will allow you to file on your new date choosing, but you are going to be doing both the new and the old, because the tax authority will be doing both new and old. And if the old is higher than the new, they will raise an additional assessment. Now let's see how this can be done. We'll go back here now. Liadi Trading Company Limited. We have Liadi Trading Company Limited. We will now say, is it change of accounting date? What are they asked? What are we asked to do? Compute the assessable profits. Compute the assessable profits. So I will say computation of assessable profits for years. We said what year to what year? 2007 to 2009. For years 2007 to 2009. All right. So you will say based on the old accounting date. And the old accounting date is March, March 31. So based on the old accounting date, we'll have years of assessment, basis period, then I will say this is assessable profit. Let me put my Naira sign here. Now I can rule this. Now the first one is 2007. 2007, and this is going to be from April 1. Sorry, this is 2007, not 9. Why am I writing it like 9? 2007. April 1, 2005 to 31st March. March is 3. To 31st March 2006. So what do we have? April 1, 2005 to 31st March 2006. We have 120,000. That's it. Let me bring it down here. 120,000. I would like to leave this long space for walk-ins. Okay. Then we have for 2008, 2008, based on the old dates, this is going to be April 1, 2006 to March 31, 2007. Let's see if we have anything like that. April 1, 2006, most especially March 31st, 2007. We cannot find March 2007 here. March 2007 can be found here. But April 1, 2006 is here already. And down to December is 9 months. So we'll take the whole of these 9 months and we'll look for 3 months here. We'll look for 3 months out of this 12. So we'll take the whole 75,000. So I will say this is 75,000 plus 3/12 times 240,000. 240,000. Okay, so let's activate our calculator. We start with the one that has the fraction. Start with the one that has division. 3 divided by 12 times 240,000. That's 60,000. You add 60,000 to 75,000. That gives us 135,000. So we are going to write 135,000 here. Now, that is how the tax authority will be basing theirs. For 2009, we have 1st April 2007 to 31st March 2008. So where can we find 1st April? 1st April can still be gotten where this 12 months is. And we're going to take 9 months. Remember, we took 3 months before for the right period. We're going to take 9 months here. Then we're going to take 3 months remaining here. It's 240 and 28. So we'll come here and say 9/12 times 240 plus 3/12 times 28. Let's be sure we picked the figure correctly, 28. So let's bring our calculators. We will say 9 divided by 12 multiplied by 240,000. That gives us 180. We will now bring the second one. 3 divided by 12 times 28,000. That gives me 7,000. So we are going to add this 7,000 to our 180. It gives us 187. So write your 187 here. 187,000. Now, when you have done that, the next thing to do is to add these together. Let's add them together. We already have 187 down here. Add our 135,000. We now add our 120,000. That gives me 334,000. I'll write my 334,000. So this is the sum of assessable profits. Now this is based on the old accounting, the old dates. Let's look at Based on the new date, we come down here. Based on the new accounting date, which is December 31st. So let's confirm that it is December, yes, from March to December. So we will start again. We are doing it from 2007, 28, and 29. So this will be our year of assessment. I would like to give this 2007, 2008, and 2009. Then this is going to be basis period, and this will be accessible, accessible profits. And this will have our Naira sign. I'd like to rule the line again. All right. So based on the new date, 31st December is our date. So it means that this must be from January 1, 2006 to 31st December 2006. The question now is, where can we find January 1, 2006? January 1, 2006 can be found here because this starts all the way from April 2005 and ends in March 2006. So January can be found here, and January to March is just 3 months. We are going to take 3 months out of this 12. Then we will take the remaining 9 months to December. See, this one ends in December 2006. We take these 9 months and add it to the 3 months from here. So 3 months of 120 plus 75,000. So you will say 3/12 times 120,000 plus 75,000. So let's calculate. Let's bring our calculator down. So we have 3 divided by 12 times 120. That gives us 30,000. Now when we add our 75,000, we have 105,000. So we are going to write 105,000 here. Now this will now be January 1, 2007 to 31st December 2007. Now in this case, there will be no workings in the second one because the company had been filing since then on the new accounting date. So we just go and pick the one that has December 31st, 2007. This is December 31st, 2007. It's 12 months. Pick our 240. So we come there here, write our 240,000. And this last one here is going to be on January 1, 2008 to 31st December 2008. Once again, since the company has been filing on the new date, just go and pick it. That's 28,000. Come down here, that is 28,000. So we have done it. Let's see how we can add and determine the one that is applicable. So we have 105, 240, 105 is here already, plus 240,000 plus 28,000. That gives me 373,000. So this is 373,000. So this is sum of accessible profit. So now comparing 373,000 with 334,000. So because the company has started paying in line with the new dates, the FIROS will not give them additional assessment because they will choose the higher of the two and they will choose the new one. Now, assuming the figures were changed and the old one was 373 and the new one was 334, the FIROS will issue them the difference between the two as an additional assessment because they must pay the higher of the two. So they must be charged. This is not tax here. This is accessible profit. It is from this profit that their taxes will be charged. So they will choose accessible profit that is higher for the 3 years combined. Note this, they will not compare 2007 and 2007 together and choose the higher one, then go and compare 2008 to 2008 and choose the higher one, and then compare 2009 to 2009 and choose the higher one. If they do that, it will be ridiculous because they'll be choosing 120, 240, and then 187. That would be ridiculous. That is not how they'll do it. They'll choose the set that gives the higher sum. So the tax authority will choose based on new accounting dates. So they will choose based on the new accounting date. All right. So that's it. We've done accessible profits. We've done commencement rule. We've done uh, cessation rule. We've not done for change of accounting dates. What is now left now is this assignment here. We will solve this based on the old dates. Then we will come back again and solve it based on the new tax rule. Okay, so exercise 1.4. CAN Limited commenced business on October 1, 2001. So I will be writing my points here. So this is exercise 1.4. So this is exercise 1.4. Let me give it a different color. Exercise 1.4. This is CAN Limited. CAN Limited. All right. Now, given, these are the things that are given. Commencement. commencement 2001. Right? That's the date it was commenced, October 1, 2001. So I would like to write the date, October 1, 2001. So I'll put the actual date, October 1, 2001. I'll say October 1, 2001. However, the company chose 31st December as its accounting date. So I'll come down here and I'll say account year end should be December 31 every year. However, okay, in the tax year 2006, the company wrote to FIRS notifying the Revenue Service of its intention to change its accounting date to May 31st. Okay, so this now becomes the old date, and I will come and say new accounting year end is March 31st. Is it March or May? Oh, it's May, not March. So change this to May 31st. So this is the new date, then this is the old date. Now, the year should be year of change, should be 2006. Later in the year 2010, due to harsh economic cessation, recession, the company collapsed and folded. So I will now say cessation year 2010. I will call it ultimate year, ultimate year. So therefore, penultimate, penultimate year will be 2009. Okay, now let's look at the actual dates in which the company ended. Looking at the whole information, January 31st, 2010. So I'll come here, 31st January 2010. That's the date that the company ceased. Now, you are given the following accounting information from when the company started operations to when it ceased to exist. Now, you are asked, apply the rules of commencement, change of accounting date, and cessation of business. Find the assessable profit for all 10 years of assessment from 2001 to 2010 tax year. So this is what we are going to do, 2001 to 2010. So what I will do here now is to say this is my year of assessment. I will start 2001, 2002, 2003, 2004, 2005, 2006, 2007, 2008, 2009, 2010. Now this is my 10 years. Then I will come now here and I will write my basis period, basis period. Then this will now be workings. That's WK. Then this will be my accessible profit. And this is going to be Naira sign here. So this is how I plan to do it on here. So this where our answers are going to be here. So we'll take them one after the other. Now, the first year that the business commenced, there is no doubt that the basis period is always known. It's going to be from the day the business commenced, and the year the business commenced was what year? October 1, October 1, 2006, 2001, and it's going to end on 31st December 2001. So it doesn't matter your account year end, it's always going to end on the 31st of December every of that first year. So we are looking for October 1 to December 31st. Where can we find it? This is period. Now this period started from October 1, 2001, and it's ending here October 31st. So this is 3 months. Oh, sorry, this is 1 month. From October 1 to October 31st is 1 month. But what do we need? How many months do we need? October, November, December. We need 3 months. But we have 1 month already. Okay, so I was explaining that the first year of assessment will always be from the commencement date, October 1, and it will end on December 31st of that year. Now, this period is a 3 month period. This is a 3 month period. How do we get these 3 months? We are going to get it from our account here, from this October. This period started from October 1, 2001, and this is 1 month. This is 1 month. So it means that we'll need to get the remaining 2 over 12 from here. So we are going to take the whole of 1, the 18,000, and 2 over 12 of this. So we go, we'll do the workings down here. And so this is workings number 1. And we'll start workings 1 to 2001 year of assessment. So assessable profit will be 18,000 plus 2 over 12 times, is it 105? 105. So we write 105. So let's activate our calculator here. We start with the one that has fraction. 2 divided by 12 times 105,000. That's giving me 17,500. Add that to 18,000. That will give me 35,500. So I'll put my 35,500 and I'll take it straight up. 35,500. 35,500. Now my 2002 will have to start again from October 1, when the business commenced, 2001, but we are going to be doing for the first 12 months of business. That's the old rule. From the date of commencement of business, you count 12 months. That means this should be from October to September 30. September is 9, 2002. So this is workings number 2 from October 1, 2001 to September 30th. So I will come down here. This is workings 2, year of assessment 2002. From October 1, we have this 1 month period, and we are going to be taking the remaining one that ends in September. This ending is in October already. So we are going to take the remaining 11 months here to complete. So this is 1 month plus 11 over 12. So we have 108 and 105, sorry, 18,000. So we'll say accessible profit is going to give me 18,000 plus 11 over 12 of 105,000. So let's do that. We have 11 divided by 12 multiplied by 105,000 plus 18,000. That gives me 114,250. 114,250. 114,250. So I'm going to take it up down here. 114,250. 114,250. Now the third year is going to be on preceding year basis. So our preceding year basis, when is our account year end? December 31st. So we'll come down here and we'll do December 31st. But it's going to be in preceding year basis. This is going to be 2002. So this will start from January 1, 2002. So we're going to do that in workings 3, January to December 2002. So workings 3, year of assessment 2003. So it's going to be from December 1, 2002 to January 1, 2002 to December 31st, 2002. All right, so let's see where we can get January 1, 2002. We can get January 2002 here. So this is September, this is October. So from January to October is 10 months. So we are going to be doing 10 out of 12 here, because from January to October is 10. Then the remaining 2 months, we are going to be doing 2 over 12 here, 105, 120. So we'll start here. Assessable profit will be 10 over 12 times 105 plus 2 over 12 times 120. So how do we calculate it? We have a 10 divided by 12 times 105,000. That gives us 87,500. Then we will do this other one here. 2 over 12 times 120,000. That gives me 20,000. If I add my 87,500 to 20,000, it gives me 107,500. So I'll have my 107,500 here. 107,500. That's what I got here. I'll take it up 107,500. I'll take it up here. 107,500. Okay. Now, the next year, which is 2004, is going to be from January 1, 2003 to 31st December 2003. Go to workings 4 and do that. Workings 4 which is year of assessment 2004, will be from January 1, 2003 to 31st December 2003. Then our assessable profit will be, let's check when we'll get January 1, 2003. January 1, 2003 will be here. So we are going to be taking the first 10 months. We're going to take 10 from here, 10 over 12. Then we'll come here and take the remaining 2 over 12. So 10 over 12 of 120, 150, 2 over 12. So 120, 150. 120, 150. So now let's see how it's going to be. So this is 2, sorry, 10 divided by 12 times 120, and that gives me 100,000. Then we have 2 divided by 12 times 150. That gives me 25,000. If I add my 100,000 to 25,000, that gives me 125,000. So I'll come here and I'll write my 125,000 here, and I'll take it up 125,000. Then for 2005, I'm going to be doing similar things. January 1, 2023, sorry, 2024 to 31st December 2024. So look at workings number 5. Workings number 5. And I'll say workings 5. Year of assessment 2005, to be from January 1, 2004 to 31st December 2004. Now the assessable profit will be, where is January 1, 2004? It has to be from here. We are going to be taking 10 over 12 here. Then the remaining 2 months, which is going to be from November, December. This would have started from November. This should have started from November 1. This is 2024. So we have November and December. We will now take 2 months out of 7. So this started from November down to May, 7 months. So this is going to be 2 over 7 here. So 150 and 90. So this is going to be 10 over 12 times 150 plus 2 over 7 of 90,000. So we'll start with 10 divided by 12 times 150,000. That gives me 125. Then we'll come here, 2 divided by 7 times 90,000. Let me check again if it's 90,000 I was given. 90,000. All right, so let's do it again. Two over 7 times 90,000. We have 25,714. Let me add it to here, 25,714. That will give me 150,714. So I'll write my 150,714. 150,714. I'll take it up. 150,714. Now, when it comes to 2006, remember our year of change is 2006. So for 2006, I will look at working 6. For 2007, I will still look at working 6. For 2008, I'm going to look at working 6. This is because I will need to do change of accounting date, and I will pick the one that is higher. All right. So I will come now for 2000 and working 6, which is for 2006, and I will say working 6, change of accounting date for 2006 to 2008. I will say based on old account date, which is December 31st. So I will do year of assessment, basis period, then I will say assessable profit. Then I will say this is 2006, 2007, 2008. Now, based on the old accounting date, this should be January 1, 2005 to 31st December 2005. This should be January 1, 2006, 31st December 2006. This should be January 1, 2007 to 31st December 2007. So where can I get January 1, 2005? I will get it here. So it means I will be taking 5 out of 7. 5 out of 7 here. Then I will be taking 7 out of 12 here. So that 5 plus 7 gives me 12 months. So 5 over 90, 5 over 7 of 90, 7 over 12 of 126. So 90 and 126. 5 over 7 times 90 plus 7 over 12 of 126,000. So let's bring our calculator. And this happens to be 5 over 7 times 90,000. That gives us 64,000 and some fraction. Now let's do this. 7 over 12 times 126,000. And this gives us 75,000. Now let's add this 64,286. Sorry, 64,286 to it. And it gives me 137,786. 137,786. Now let's go to the 2007. In 2007, of course, I'm going to be taking from here. Just a moment. Two 2007, we are looking for January 1, 2006 to December 31st. So, of course, here will contain January. I'll be taking 5 months from here. I'll be taking 5 over 12 here. Then here, I'll be taking 7 over 12. So 126, 180. 126, 180. So I'll come here. 5 over 12, 126. Of course, we've taken 7 before. Now we're taking the other 5. Then this is 7 over 12 times 180. Okay, so what do we need to do? 5 divided by 12 times 126,000. That gives me 52,500. Then I will do 7 divided by 12 times 180,000. 105. If I add 52,500 to it, I'm going to get 157,500. So I have 157,500. Then the last one, of course, I will be taking, for the last one, I'll be taking 5 over 12 here and 7 over 12 here. 180, 108. 180, 108. So this will be 5 over 12 of 180 plus 7 over 12 of 108. All right, so let's activate it now. This is our calculator. 5 divided by 12 times 180. That gives me 75. Then 7 divided by 12 times 108,000. That gives me 63. If I add 63 to 75, I have 138,000. Now I have 138,000. Now when I do that, I will now sum these three. Now that's 138. I have a calculator having 138 with me. So all I will need to do now is I will add plus 157,500 plus 137,786. Now that gives me 433,286. Now that's based on the old accounting year. So when you've done that, you go under and say based on the new accounting date, which is May 31st. So you still have your year of assessment, basis period, and your assessable profit. You have your 2006 again, 2006, 2007, 2006, 2007, and 2008. Now, because we are ending in May 31st, so this is going to be 31st of May 2005. So this should have started, because it's 31st of May is ending, this should have started in June 1, 2004. Similarly, this should start from June 1, 2005 to end in 31st May 2006. This should start in June 1, 2006 to end in 31st May 2007. So let's check where our June 1, 2004 lies. June 1, 2004. Where can we find it? This is 2004, ending in October. That means there will be June here. So we have June, July, August, September, October. So we have June, July, August, September, October. So that's 5 months. It means we are taking 5/12 here, and we are taking the whole of these 7 months. So this is 7 months. So we take this 5/12 of 150 and the whole of 90. 5/12 and 90. So we say 5/12 of 150 plus 90. Let's be doubly sure. I will pick the right figure. Yes, 150 and 90. So bring down our calculator. 5 divided by 12 times 150, that's 62,500. If we add 90 to it, it becomes 152,500. 152,500. 152,500. Now the next one will be June 1, 2005 to to May 31st, 2006. Okay, let's check where we are going to see it. From June to May 2006. So this is the whole figure. We are taking the whole 126 because it ends on our accounting year end. So you see, when they change the accounting year, they always file on the new date. So we take the whole 126 here. So this is going to give me 126,000. So the same thing lies in for 2028, 2008 rather. We are going to be taking the one that ends in 2007, the whole of the 180. So we'll go down here and we'll take 180. Less stress in workings. We'll come down here and bring our calculator, and we have 152,500 plus 126,000 plus 180,000. That gives me 458,500. 458,500. Now we are going to check if the old and the new, the old and the new, which one gives us a higher figure? The new one has given us a figure of 458,500, and here is 433,286. So we are going to be taking based on the new one. So we'll say FIRS will choose based on new account dates. So now we are going to take everything we have in this new accounting date and put it in our main answer. So we are going to be choosing from the new accounting date. So it will be from June 1, 2004 to 31st May 2005. June 1, 2005 to 31st May 2006. June 1, 2006 to 31st May 2007. Let's get the figures and write it down. 152,500, 126, and 180. 152,500, 126, 180. All right. So this is for those years. Okay. We are now left with 2009 and 2010. Now, 2009 is penultimate year. So we're going to look at workings number 7 for 2009. So remember how we treated penultimate year. So we are going to go now working 7, workings 7, year of assessment 2009, penultimate year. Okay, so we'll say based on PYB. Now, because we have now adopted the new accounting dates, our PYB will be, we'll put the last date first, 31st of May 2008. Of course, it will be from June 1, 2007 to 31st December 2008. So let's see whether we have that 31st of May 2008. We have 108. So 108, 108. Now, based on actual year basis, based on AYB, which is January 1, January 1, 2009 to 31st December 2009. We are going to do workings. We are going to do some workings. Where can we find January 1, 2009? January 1 can be found here, 2009, and we are going to take 5 months out of the 12. Then where can we find December 2009? We can find it here. But the thing is, how many months is here? We have from June 1. This starts from June 1, 2009. So we have June, July, August, September, October, November, December, January. 8 months. So this is 8 months. So we have from June to January. We are going to take the remaining 7 months here out of 8. So 5 over 12 in 138, 7 over 8 for 60, 138 and 60. So it's going to be 5 over 12 times 138 plus 7 over 8 of 60,000. Okay, so we activate our calculator once again. 5 divided by 12 times 138,000. And that gives me 57,500. We pick the second one, 7 divided by 8 times 60,000. That gives me 52,005. If I add 57,500 to it, I have 110,000. Now, based on the FIRS, they will choose FIRS will choose based on AYB. This is higher. AYB gives us 110,000. So take it down, down, down. So I know it's 110,000 and it's AYB January 1, 2009 to 31st December 2009. Now, for 2010, which is the year of cessation, is going to be on AYB January 1, 2010 down to 31st January 2010. We'll do that in workings 8. Let's see how we are going to do it in workings 8. Workings 8, ultimate year. Year of assessment 2010. Okay, so it is going to be assessable profit will be, okay, basis period will be January 1, 2010 to 31st January 2010. Now, this is where 31st January 2010 ends, and it's 1 month. So we are going to be taking 1/8 of 60. So it's going to be 1/8 multiplied by 60,000. That will give us what? 1 divided by 8 times 60,000. That will give me 7,500. 7,500. So we take it down, 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 down to our solution, and we write our 7,500. Now, this is the old tax method. Now, I'm going to be giving you an assignment for you to use the new method, the new tax rule, whereby I'm going to be changing these dates for your assignment. I'll give it a different color. I'll give it a different color here. So for your assignment, this happens to be 2021. Now this will be 2026, and this will be 2030. Let me write it down here. 2030. So we change it again. This is, I'll put it here, period to 31st 10 2021. This is year to 31st 10 2022. This is year to 31st 10 2023. This is year to 31st 10 2024. That this is period to 31st, okay, 31st May 2025. And this is 31st May 2026. This will now be 31st May 2027. And this will be 31st May 2028. This will be 31st May 2029. And this will become 31st January 2030. So this will be your assignment. Now you will be using the Finance Act 2019-2020 method. So that's your assignment. In the next class, we are going to look at the solution to these assignments, and we are going to also go to the next topic for consideration. This has been a very long class, and I am grateful that you could find time to join this about 3 hours class. And I want to use this opportunity to say, please watch the video again. This is foundation knowledge you need to learn for you to be able to solve taxation questions. That's why these sessions have been long. If you understand the old method and the new method, then you are in line to be able to master how to solve basic period questions in taxation. If you have any question, please send it to my WhatsApp message or to my email, and I'll be glad to answer you. So thank you so much for coming to this class. See you again in the next class.